Let's start off
Samantha.
looking with expectations from the market regarding the MPC decision today. As I said, Ndungu is going to need to weigh up issues around surging inflation and the free fall in the currency against an impact that interest rate hikes will have on economic growth going forward. Most are looking for interest rates to be hiked to up to 10% from the current 7%. What are you looking at?
I'm looking for, from today's meeting, I'm looking for more guidance on the exchange rate with regards to, I think, two things. First of all, I think CBK needs to be seen to be taking control of the currency and not letting it slip to Parliament, because Parliament is opening soon. So I think that's one thing that's driving this meeting in terms of trying to avoid politicizing the process. Secondly, I think last week the CBK said that it will sell currency direct to importers. So I think they are working on, they're going to be meeting to work on the finer details so as to avoid creating arbitrage opportunities for importers. With regards to interest rates, I am not of the opinion that interest rates will be beneficial at the moment, given the current sputtering growth you're witnessing and the current high inflation environment.
So you're not calling for an interest rate hike?
No, I don't think an interest rate hike will be beneficial. Last month, you actually saw interbank rates touching 20% without any material effect on the shilling. Therefore, the argument for an interest rate hike, I don't think is strong at the moment. What the central bank should be doing instead is giving more guidance on the exchange rate. For instance, they could say that they're comfortable with a shilling at 90 shillings and to the dollar, and say that they will buy currency until the shilling reaches that point. I mean, that will at least create expectations to the market as to where they see the currency they are comfortable with the currency. So I think the MPC meeting should be more focused on providing exchange rate guidance than hiking up interest rates.
Now, Governor Ndungu has already said, though, that they're committed to a free market exchange rate, a floating exchange rate. So you're calling for a peg, in a way, for the exchange rate, similar to what we have in Nigeria, which uses the peg in order to cushion against imported inflation.
I wouldn't call it a peg, but more of a managed float, because I think the central bank needs to be seen doing action towards the exchange rate, because given that you're a net importer, a weak currency has direct benefits, I mean direct consequences for the vast majority of the population. If you look at what the Swiss National Bank did, I think the same period last month, when the Swiss currency was becoming too strong over Eurozone fears, they actually did the same thing. They said that they gave the level that would be comfortable with the franc, and they bought currency. And what happens in such a situation is that the market does the rest of the work for you. It actually, once banks know that shillings should be at 90 shillings or so, they'll buy shillings and sell their dollar positions because they know that the central bank is in the market. So I think you create expectations rather than actually doing it. Rather than actually buying the currency.
That predictability, especially for importers and exporters, when you talk about politicizing the whole process going forward, there have been concerns about Ndungu and his credibility. The parliamentary office, or Parliament's budget office that supports fiscal policy and looks at fiscal policy, came out saying that the central bank governor must be blamed for the depreciation in the shilling, and he sends mixed signals to the market. Do you think, this is a sensitive question, but do you think that Ndungu's job is on the line?
I think it's in a precarious position, but I think getting rid of Ndungu of Professor Ndungu as the CBK governor would be a mistake, and it would be unfair, because the vast of the problems that we're witnessing right now are based to shocks. There was the shocks in Europe because of the Eurozone crisis and Greek debt that have had a direct impact on the currency. There have been shocks with regards to the Middle East crisis in Libya, Egypt, that have had a direct impact on oil prices, and there's the drought. And all those things have happened at pretty much the same time. You could call it a perfect storm that have led to all the issues you're witnessing at the moment. Therefore, blaming a central bank governor whose purview is more of a monetary policy over supply shocks of this nature would be rather unfair.
But he did make the error at the beginning of the year, cutting interest rates when inflation, and all indications were that inflation would surge.
Yeah, there was that issue. However, with regards to his policy of cutting interest rates, I think it was more to sustain growth and sustain economic growth, given that we had the double shocks of the 2007 post-election violence, as well as the global financial crisis. So I think that was what he was looking at the time.
Yeah.
But I think the only thing you could maybe say is one of his major weaknesses, that he needs to have a less adversarial stance towards the banks, because at the end of the day, despite they hold the bulk of the currency and they hold the bulk of the financial system. So I think he should have a more reconciliatory tone with the banks rather than being as adversarial as he has been.
Let's leave it at that on the MPC decision. Quick look at the equity market. KenolKobil, the MD, coming out yesterday saying after the market closed that they're positioning the company in order to be a takeover target from a company in India, China, Arabian Gulf players, or Malaysia. How do you think shareholders will respond to this news today?
I think shareholders will respond at the market prices. The shareholders will respond by taking positions, because I think whoever is to enter and take over KenolKobil is probably going to be a very liquid and well-financed player that could offer a premium to shareholders at the current prices. And I think at 9 shillings 50, anyone getting into KenolKobil will look at future earnings and pay a premium. So it could be a good time to enter, given that there'll be foreign, deeply financed players coming into the company.
This comes at a time when Total Kenya has now issued their profit warning for the full year. They haven't been cushioned against all the issues that you've got in Kenya, and it seems diversification has really what's been playing in KenolKobil's favor, where Total Kenya is restricted to the Kenyan economy.
Exactly. I think that's the main thing, and you said it perfectly. Total is basically based in Kenya, and the bulk of the operations are in Kenya. And therefore, all the issues that we've talked about earlier, the exchange rates, the inflation rates, and the price controls have not worked in their favor. Whereas if you look at KenolKobil, they've got storage facilities across the Great Lakes region, and Zambia, Zimbabwe, and other Southern African states that really have worked towards their favor in such a volatile period for oil players.